Hey, I am Angelo Saris with Leverage Lending Group, and this is
Seth June with SH June and Associates Real Estate.
So we are going to talk about some common questions, or I guess myths, when it comes to mortgages. So you had some questions for me, so I'll let you go ahead and ask away.
Do you really need 20% down to buy a home?
Yes. No, you don't. You only need with conventional loans, the minimum down payment requirement is 3%. With FHA loans, it's 3.5%. But there's also two loan programs that require 0% down. One is a USDA loan, right? Where's the beef? You heard about that? It's basically populating the rural communities. It's based on population density. Also, VA, Veterans Administration. So if you are military, if you served in the military and you have VA entitlement, that is also a 0% down. Now, the USDA is only for certain areas, and everybody's eligible for that. There are income limits to that. So not like inside the city limits. USDA isn't eligible, so it's outskirts of city limits usually. But VA, that's the other 0% down where you have to have VA entitlements in order to qualify. So those are the four main loan programs. You have FHA, conventional, USDA, and VA. So no, you don't need 20% down. Very many people think you need to put 20% down. I think where that comes from is to avoid PMI or private mortgage insurance. People need to put 20% down to do that. So anything that for conventional loans, if you don't put 20% down payment, you have to get what's called PMI or private mortgage insurance. And what that does, that insures the lender in case of default. It doesn't insure the borrower, which people think. It insures the lender in case you default. That basically they'll cover that difference between, the 3% that you put down versus the 20%. So no, common misconception. People think you need to put 20% down. That's not the case.
For sure. And that brings up another myth. You have agents out there who are, we're going to say, uneducated with their loan programs, or they seem scared of VA loans. From my experience, VA loans they're great loans. I actually love to work with them. Can you explain kind of what the myth is and why they have fear with that?
Yeah, man, and you're right. It's uneducated agents that want to steer their sellers from accepting a VA offer. VA loans are incredible loans. They're for veterans that have served our country. Those should actually, in my opinion, those should be at the top of the list. For sure. On top of conventional or FHA loans, because they've served our country, right? They should get precedence or priority when it comes to that. But it is a common misconception that VA loans aren't good loans. But I don't really understand where that came from. Now, I will say, if the home is older, then the VA appraisal could be a little bit harder on the appraisal than a conventional appraisal. But that's if the home's really old, yes. Right? But other than that, I don't see any reason as to why you should not accept a VA loan. They're great for the borrower. I mean, it is basically hands down the best loan program when it comes to payment, interest rate. There's no mortgage insurance with a zero down. So it's the best loan for the borrower if they're eligible to get that loan.
Agreed. And usually with those VA loans, it seems like whenever appraisal comes in and tells you that you need some kind of repairs made, it's nothing really that major.
No.
It could be peeling paint or something.
Correct.
You have to scrape the paint off and clean up those scrapings.
Right.
Can't leave them in the dirt.
Big deal.
So yeah, it's not that tough. And from what I've seen with those VA appraisals as well, as if it's a special property that buyer really wants, the VA appraisers work with you more than if it was a conventional loan or FHA. I've seen that from experience.
Yeah, I definitely see that. And you're right. It's very minimal when it comes to a VA appraisal. If there's some sort of, a safety item or, peeling paint, things like that. That's really the biggest. Windows, if the home is old and the windows haven't been replaced, that could potentially be an issue. I've seen that too. But not a huge deal. That home has to be like from the 1930s, 1940s for that to really be an issue. So, yeah, I don't know why. It's become this stigma in the industry for just unknowledgeable real estate agents to want to push their sellers away from those, which I don't think is right.
Do you have to have a perfect credit score to purchase a home?
No, you don't. I mean, we can get you approved down to, some lenders even offer down to a 500. You're gonna have to be putting a little bit more money down for FHA, right? But usually 580 is the minimum for FHA and VA. Just because it's a 580, it doesn't mean, maybe somebody had, a blip in the past, right? We all go through problems. We all have, extenuating circumstances that sometimes are beyond our control. I've seen a bad 580 credit score, but I've also seen a good 580 credit score. We can get into more detail about that some other time, but you can buy, to answer your question. Just because you have a 580 credit score doesn't mean that you're not worthy. Maybe you just had some problems in the past. So yeah, that's a big miss.
And is it usually better to have a more short-term mortgage, less than 15 years versus 30, or typical?
Yeah, that's a great question. I mean, it's all on what the borrower is comfortable with, right? If you do a 15-year loan, right, or a 20-year loan, you're going to be paying more per month, but you're saving thousands in the long run, right? The average lifespan of a mortgage or somebody in a home is 4 to 7 years. So you can be getting a 30-year mortgage, and let's say that's going to be your forever home, you can get that 30-year mortgage and know that you have the comfortability of having that 30-year payment versus the 15 or 20-year payment, but then you can pay more on it to pay it off early. So the common rule of thumb for a 30-year mortgage, if you pay one additional payment per year, that you knock down that 30-year mortgage to a 25-year mortgage. So it's very easy to kind of chip away at the principal. If you put an additional principal payment on that per year, you can save a lot. You can save thousands over life loan. Not many people know that.
Yeah. So I guess it's different for each person.
Yeah. It's situational. Definitely different for each person. But the interest rates from a 30-year to a 15 right now in this market, it's about 0.5%. So it's not a huge difference in interest rate, but it's, if you look at a 15-year payment versus a 30-year payment, you're paying quite a bit more, right? So almost double. So it's just something to think about in your financial situation. So that's comfortability.
And whenever it comes to self-employed or independent contractors, is it harder for them to get approved for a loan than someone who's on a W-2?
W-2. Yeah, that's a good question. So it all depends on the longevity of that self-employed borrower. If they're newly self-employed, that's going to be difficult. They usually want to see a 2-year history. Fannie and Freddie just kind of implemented a new guideline this year, at the beginning of this year, January 1, 2024, where it said as long as they have a 1-year calendar year from Jan 1 to December 31st, if they have that on paper, they filed their taxes, they'll look at that for approval. Whereas before, they wanted a 2-year history on businesses. So now they've kind of relaxed the guidelines on self-employed. But you have to file the taxes. It has to be 1 full calendar year. So if you started your business, let's say June of this year, and you file in December, that's only 6 months. Yeah. So you can't. So it's got to be 1 full calendar year. And of course, you only file your taxes once a year. So you basically, if you start in the middle, it'd have to be you'd be open to like a year and a half. So stipulations around that, but they'd have relaxed the guidelines a little bit around that.
Cool. It's good to know. I know a lot of independent contractors hear all sorts of things when it comes to lending. So it's good to know that there is options out there if they can meet those. Yeah. I mean, and that's just conventionally. So we do have some non-conventional options that we can just go off of 1099s. And so that's just another, rabbit hole we can go down into. But yeah, there's also, some non-conventional options. Of course, the interest rate is going to be a little bit higher. Down payment is going to be a little bit more, but there are some additional options other than the conventional realm. For recent graduates, after graduating college, is it possible for them to buy if they come out of college and get a job right away that's going to be salary based?
Yes, it is. That's an awesome question. So we look at that college, 2-year, 4-year, whatever it may be. We look at that as your job history. So we can tie that together with your offer letter. It's called future income. Let's say you just have an offer letter. You haven't even started that job yet. But if it's a salary based position, and you have an offer letter with a start date that's got to be within 60 days of the funding dates, I think it is, for when you're closing on the home, we'll approve you for that loan. So We can use the transcripts from the college with the offer letter to get you approved to buy a house.
So it's awesome. So there's options for most people.
100%. Yeah.
Cool.
You just don't know until you know. That's why you need me and Seth.
Exactly. Hire the best. When people are interviewing all these lenders, everyone's looking for the best rate. Do all lenders have the same rates?
All lenders, they don't have the same rates. They have very similar rates, within maybe 0.5%, depending on, what their appetite is. Some lenders may be geared towards the lower credit score. Some lenders may be geared towards higher credit score. So it really just depends. So all lenders aren't created equal. We have access to all of the rates. It all just, it depends on if you want to buy points, right? If you want to buy to, pay to buy your interest rate down, you have a par rate. And then if you want a cheaper payment, you can pay upfront for a permanent interest rate buy down, where it buys that rate down, let's say from a 7% to a 6.5%. And there's usually a cost to that. So all lenders aren't created equal.
All realtors aren't created equal.
Very true. Very true. So, but you have to use someone that's knowledgeable, that gives phenomenal service, that has a track record, that is local, and, you can honest, right. And you can look them up, and see what they've, what they've done in the past. So that's a good way to pick a lender and or a realtor.